What if I told you that some of the most important decisions in America, where people live, how much groceries cost, which companies survive, and even how elections are influenced aren't made by politicians or CEOs but by a handful of hedge funds most Americans have never heard of? And here is the real mystery. How can firms that control less than 5% of all U.S. financial assets wield enough influence to shift markets, pressure corporations, and quietly shape everyday life? Today, we pull back the curtain to trace how this happened, not as a conspiracy, but as an evolution of money, deregulation, and power that went unnoticed until it was too late. To understand the rise of hedge funds, we travel back to the 1940s when Alfred Winslow Jones created a small, private investment pool designed to profit in any market. His hedged fund was a quiet experiment, but it planted the blueprint for one of the most powerful financial structures in America. As decades passed, deregulation in the 1980s unleashed a new generation. George Soros, Ray Dalio, Jim Simons. Men who used macro bets, mathematical models, and algorithmic trading to influence currencies, bonds, and global markets. By the 1990s, hedge funds had one key advantage: freedom. Unlike banks, they faced fewer rules, fewer disclosures, and far fewer restrictions on risk. This freedom allowed them to borrow more, bet bigger, and move financial markets with shockingly small amounts of capital. With leverage, a $10 billion hedge fund could control $100 billion worth of assets and shake entire industries. Their growing influence spread quietly until the 2000s, when they discovered their most powerful strategy yet: activist investing. Funds like Elliott Management and Pershing Square learned they could buy a tiny percent of a company and still force dramatic changes: layoffs, cost-cutting, mergers, asset sales, buybacks, and even CEO replacements. Suddenly, hedge funds weren't just market players. They became corporate kingmakers. At the same time, private equity giants using similar strategies began buying entire neighborhoods, turning family homes into national rental portfolios. Quant funds gained control of daily trading volume, with algorithms eventually dominating more than 70% of U.S. stock trades. The rise was complete. Hedge funds no longer simply invested in America. They shaped it from within. But as power expanded, consequences followed. In 2008, hedge funds were central players in both the collapse and the profit-making around mortgage securities. In 2020, pandemic volatility shattered some funds while enriching others. And in 2021, the GameStop saga revealed to the public just how deeply hedge funds were entangled in market mechanics. The fallout extended far beyond Wall Street. Private equity ownership of over 400,000 single-family homes helped drive housing costs upward. Activist-driven cost-cutting contributed to layoffs, outsourcing, and wage stagnation. Consolidation pushed consumer prices higher. And algorithmic trading made markets more fragile, triggering flash crashes and sudden swings. Attempts to regulate these issues repeatedly failed. Laws like Dodd-Frank increased reporting, but hedge funds responded by shifting operations offshore, structuring risk through unregulated derivatives, converting into family offices, and lobbying to shape financial rules in their favor. The system meant to constrain them became one they quietly influenced. Today, a familiar pattern repeats. 8 hedge funds control more equity assets than over 50 million American households combined. Activist campaigns have targeted more than 700 major U.S. companies. Private equity owns 10% of U.S. hospitals and tens of thousands of doctor practices. Algorithms, not humans, drive most of the stock market's daily activity. And new frontiers: AI companies, farmland, water rights, and digital infrastructure are becoming the next battlegrounds. The pattern is clear. While hedge funds do not control America directly, they influence its structure through leverage, strategy, and regulatory gaps that reward aggressive innovation. 3 takeaways stand out. First, influence in the modern economy doesn't require size, only the ability to leverage and pressure large systems. Second, regulation always lags behind financial innovation, allowing hedge funds to stay one step ahead. And third, the real story isn't a secret plot, it's a financial framework that rewards speed, opacity, and risk-taking over transparency and stability. The warning is simple: if past crises teach us anything, hedge funds will not only survive future shocks, they may emerge with even more control over housing, healthcare, corporate America, and financial markets. And most people won't realize it until their rent rises, their job changes, or the markets suddenly swing. If you want more deep dive investigations into the hidden mechanics of money, power, and global systems, subscribe to the channel. Leave a comment on what surprised you the most, and share this video with someone who wants to understand how modern power truly works. Because the more we understand the system, the less invisible it becomes.